Hi, welcome to the first episode of the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and founder of Moore Squared Communications. So what is the Professional Investment Podcast? Every episode, I'll have a guest on the show who's involved in the UK's largest investment organisations. They'll be sharing their news story of the week with us. And I'm delighted to welcome our first guest to the show, Dan Mikulskis, Chief Investment Officer of the People's Partnership. Hi, Dan.
Hi, Charlotte. Yeah, great to be here.
Please tell us, what news story do you want to share with us this week?
So I am sharing the news story from the 4th of September of this year. And it was a story that NVIDIA lost almost $280 billion of market capitalization in one day, which was a record.
That is a lot of money to lose in one day. Do you want us to tell us a bit about, why tech stocks have been so important, why they're so volatile, and how they move so much and what that means for the market?
Yeah, exactly. Yeah, I mean, the reason I chose this story is because there's a lot of layers to it, I think. I mean, in one sense, you've got the sort of sticker shock of those huge numbers, but then you get on to questions around the technology sector, the composition of indices, the nature of markets, passive investing, the way market dynamics have sort of changed. So there's actually quite a lot of layers to get into here. But if I maybe just sort of go through my kind of first and second reactions to that headline, if you like. So the first reaction is to say, well, I mean, goodness me, what a mind-bogglingly huge number, right? Just to say again, $280 billion, and that's the loss in one day of market capitalization. The largest stock in the UK is around about 200 billion. So you're talking about gaining and losing a whole AstraZeneca plus GlaxoSmithKline, two huge global companies. You're talking about gaining and losing amounts of market cap equivalent to that, sort of every single day. So it's a little hard to wrap your head around, isn't it? Really, just quite how large these big companies in the US are. So that's the first reaction, quickly followed by the second reaction, which is kind of to shrug a little bit and just sort of say, well, but so what? Big companies go up and down by big amounts every day. That's what you expect. If you're a 3 trillion company, then 9% of 3 trillion, you get to big numbers. So that's the sort of initial reaction, and then the secondary sort of shrug. Well, so what kind of thing.
Yeah, but it does. I mean, we've had a lot, haven't we, about just how much the tech stocks make up of whatever index you decide to look at, whether it's S&P 500 or MSCI World or even MSCI ACWI, which takes every stock in the world into consideration. And there are concerns about concentration risk, aren't there?
Yeah, I mean, so some folks worry about concentration. I'm not a big worry about concentration. I got to be honest. There's been quite a lot written about it over the last couple of years. It's been a kind of big theme that's been discussed a lot. What I would say is, you've got to make sure you're always talking about the right thing. Often those articles are focused on the S&P 500 index in the US, where the largest stocks there are about 6 or 7% of the index each. And that's relevant maybe for US investors, but for most of us folks investing globally, it's more relevant to look at their weight in a global index. And often there, the weight can be something 3-4%, something like that. So still a lot, but not quite as extreme as when you're looking at the US. And there's a few other points as well. That there are you can find plenty of examples of other markets around the world that are even more concentrated than that. The UK market's actually pretty concentrated if you look at that individually. The Danish market is, if you look at that individually. And back through time, at certain points, there has been sort of equivalent levels of concentration. So that's one thing. And then you can sort of, you get into a philosophical debate, don't you, around things like market efficiency. Where is it obvious that those weights are sort of too high or too low or whatever? And everyone has will have their own sort of philosophical viewpoint, I suppose, on where they stand on market efficiency. And I'm generally more toward the side of believing in market efficiency. So would kind of generally say, well, those stocks are big because they deserve to be big. And when you look at the fundamentals, so you look at the earnings, the cash, that's definitely been there these last few years. So, NVIDIA is up by hundreds and hundreds of percent in the last couple of years. You know what else is up by hundreds and 100% is NVIDIA's earnings and cash flows. And so you sort of look at things like that. There's a really good paper on that by Michael Mauboussin recently, a great sort of investment researcher, and he showed that actually certain measures of economic profits in the US market are even more skewed to the top stocks than even the market capitalization would suggest. So it certainly isn't the case that market capitalization is all sort of just hype and completely unjustified. That there is a lot of sort of fundamentals there, and as I say, I'm probably more on the side of saying, well, yeah, markets are probably broadly efficient. They probably broadly get these things right most of the time, and so it's not kind of obvious that it's wrong, and therefore it's not kind of obviously a problem.
Yeah, I mean, I remember when I was an investment analyst, we had a very simple metric that we used to use all the time, which was called a PEG ratio, price earnings to growth. And that's exactly what you're saying. You can have a punchy price earnings ratio as long as the growth is there, then you are paying for the right thing.
Yeah, exactly. And I think that often gets missed, actually, the growth piece. I mean, people can get quite focused on just looking at price earnings ratios. They often miss the growth bit. But clearly, that those stocks have expectations embedded in them about growth, right? That this is a really important point that I would make about stock markets generally. A few days before that headline, in fact, NVIDIA had announced its results. Those results were, for all intents and purposes, pretty good. Revenues had increased massively, but the market fell a little bit in the days after that, and that's all to do with the expectations that become embedded in these stock prices, isn't it? And as you say, the expectations now are that the growth is going to be really high in those companies. So it's very easy for them to announce results that look really good, but they can disappoint against the expectations a little bit. There have also been times when they have outperformed even those high expectations as well. So again, it's not to say that because expectations are high, you're always going to be disappointed. It could happen the other way, and that's back to my point about market efficiency. In hindsight, obviously, it will be too high or too low, but most of the time, it kind of weighs things reasonably well.
So you're not concerned by market concentration risk because, to your mind, the fundamentals are still there, and it will all come out of the wash at the end of the day. Is that a good summary of why you don't worry too much about concentration?
Yeah, I think that's fair. I think believers in market efficiency naturally wouldn't worry about concentration because you would say, well, it's sort of kind of justified. And then, yeah, that secondary point I made about being global rather than just focusing on the US, I think is also a little bit of a comfort as well, isn't it? That actually, if you look globally, a lot of the numbers are not as stark as if you just focus on the US. And then finally, if you zoom out historically, you can go back to periods in the kind of 1960s or whatever, where you did have dominant industries that were, comparably dominant to how the technology industry is today. So, people will obviously jump to the late 1990s, early 2000s as kind of as a big worry point that we're looking at something similar. But I think that can be a little bit overdone sometimes. And as I say, if you look into the actual details of the fundamentals and the earnings and the cash that's being generated, and you look at other periods in time, I think you don't need to focus on that as the obvious comparator.
So what does NVIDIA's sort of wild gyrations, what does it tell us about the opportunities and challenges of investing passively?
Well, I mean, as I said, I think there's another layer to the whole story, which goes to the sort of market dynamics and the sort of almost market microstructure of what sort of drives markets day to day. And there, the trend towards passive investing is obviously a huge factor. I would say it's been one of the biggest trends that I've seen over my sort of 20-year career. Just a lot more assets are held passively these days, and of course that means you buy a lot of the biggest stocks. That's what passive investing involves, kind of to state the obvious. And then there's nothing inherently wrong with that. And in fact, passive investors don't tend to trade very much. Obviously, they don't turn over a lot. Lots of people investing passively are paying in every month into their pension, exactly like our members and customers do every month into the pension here. But that happens all the way around the world, and so that creates a sort of marginal buying tendency, but that is spread across the board, so it doesn't necessarily benefit the biggest stocks. In terms of passive investors, I think most passive investors should look at headlines like that and broadly shrug, really, and not be too bothered about it. NVIDIA is up something like 100% so far this year. It was up 300% last year. And as a passive investor, you've benefited from all of that, which is great. And then there's certain days when a chunk of it will get taken back, and that's just par for the course. That shouldn't worry you too much. The thing about a passive investor, you will broadly get exposure to the themes that the market believes are important at the right time. So passive investors didn't need to predict that AI was going to be a big driver, that the market kind of did that prediction for them and gave them the exposure to NVIDIA and other stocks sort of around about the right time. Now, obviously, you're never going to be ahead of those things. But passive investing over time does a pretty good job of adjusting to the right themes of the day. The biggest sectors in the indices have actually changed quite a lot over the decades. So I think as a passive investor, you have the luxury of being able to sit back, not get too bothered, not get too het up about any one NVIDIA earnings release or sort of daily plunge in market capitalization. I do think one thing that's interesting is some of the stuff that happens at the other end of the spectrum in terms of trading timeframes.
And by that, you mean?
So by that I mean I think what people find is that the trading patterns in the markets have changed quite a lot, and some of it's to do with your more traditional active managers operating on those kind of medium-term timescales. There are less of those and more passive managers, but you now do have a lot more folks doing individual stock trading, for example, in the likes of, say, Robinhood or comparable kind of brokerage platforms in the US. And you've also got these trends towards these things like 0 days to expiry options, which are effectively options of where they're effectively contracts for where a stock price is going to close that day's trading. So really quite short-term instruments. And I think that those are quite powerful forces in markets at the moment, the way things go. Like I say, you've sort of got that bifurcation of a lot of people investing passively with very little activity, and then a small group of people investing with platforms like Robinhood or the 0 day options sort of very, very actively at that shorter end. And I've heard asset managers say that that kind of activity tends to get disproportionately focused on the very biggest stocks in the US. So the kind of top 20 names in the S&P have an enormous amount of trading volume in them every single day. But beyond that, so the trading volume decreases quite a lot. So you've seen it in the past with the likes of Tesla, of course, was very popular with those kind of investors a few years ago. And that is just going to lead to huge swings on certain days in the share price, where you've got a lot of folks on those platforms who are buying it or selling it, or buying options or selling options on it on a certain day. And I think day to day that could increase the sort of the volatility a little bit. But again, I don't want to sort of put that forward as something folks should really be worried about. If you're a passive investor like we are, I just think you get to not really worry too much about that, because those sort of things will even themselves out. There'll be ebb and flow a bit over time, but it's not a sort of big strategic thing that you need to worry about.
Yeah, so that would be manna to heaven for market comment pieces. Lots of nice juicy headlines like the one we've had today, which will help them to boost their circulation. Dan, will you talk to us a bit more? You've mentioned the fact that you do invest passively. Can you talk to us about how you use passive investment in your default fund, and just talk to us more broadly about your investment strategy for the default fund for your scheme members?
Yeah, sure, absolutely. So a People's Partnership with the provider of the People's Pension. It's a £29 billion DC Master Trust in the UK, one of the larger ones. We have about 6 million underlying customers who effectively have a pension with us. Most of those folks are paying in every month through their employer into the pensions that they have with us. And we invest that money, and we have a default investment strategy, which is what those folks will go into if they don't make a choice, and that's where most people end up. And that default strategy, when people are a long way from retirement, is investing in more growth assets, and then when they get closer to retirement, it sort of blends into a what we call our pre-retirement fund, which is where folks end up a few years before retirement. But the basic components for both of those are passive at the moment. On the growth side, we have about half a dozen kind of regional equity passive funds. We have a sort of North American equity fund, a European equity fund, a UK fund, Japan, Asia Pacific, and emerging markets, and those form really the lion's share of that growth piece. And individually they're passive. They track the indices that we give the manager to track, and we bring those components together in the proportions that we think are right. We also have some bond funds. We have some corporate bond funds and government bond funds as well that sort of sit alongside it as well. But those folks who are early in their careers with us, they'll be investing more in those kind of equity passive funds, and then as they go through their life, those funds will automatically be shifted more into the kind of bond funds that we run. It's a fairly standard process called lifestyle and glide path.
Yeah, the idea being that you are locking in those gains that you've made during those years of equity investing. And you've done something quite unusual, I think, and actually picking lots of different regional funds rather than just picking a big index. Can you talk to us about why you went for that approach rather than just MSCI World or MSCI ACWI?
Yeah, that was a deliberate choice. We just wanted to be able to kind of own the allocations to those specific regions through time, so that we could set them, or we could advise the trustees to set them how we wanted, really, rather than having to only accept the sort of overall market capitalization. As I say, I'm generally a believer that the overall market cap is probably about right, but I do think there are times when you can maybe look at them and say, well, actually, do we think there's maybe a little bit more expected return available in, say, the UK compared to the US, or Europe compared to the US? I think you just want to be able to retain that ability to allocate slightly differently to that, and you might not choose to use it the whole time. We do a little bit at the moment. We don't have big differences to the market capitalization, but it's just quite nice to have that. All sorts of strange things could happen going forwards, and you might want to be able to reduce your allocation to particular regions or increase it to others. As I say, a big trend of my whole career. I remember 20 years ago as a grad investment consultant doing the work for lots of pension funds, moving away from sort of FTSE all-share benchmarks towards these kind of global benchmarks with different kind of regions. And as you say, that's translated into just one single global market cap fund. But I do think there's something to be said for just unpacking that a little bit, so you have the individual regions. Yeah,
and then that gives you the flexibility. You can either match the proportions that would be in the index at the moment, or you can move away from it. Is there any sort of, you said there might be all kinds of strange things. Can you think of anything in particular that might happen that might make you want to change your allocations?
Yeah, I mean, I'm a big fan of sort of brainstorming, actually, and just sort of thinking through scenarios. So I should try and debate this with the team all the time. But you could say, well, okay, what if the US equity market doubled in the next 6 months, right, or over the next year? Maybe that's a little bit outlandish. I don't know, maybe 50% would be a better. But what if there was a really strong increase? And that's actually not the thing that people tend to think about, because people, when you think about crazy scenarios, people always think, oh, what if the market halves or falls by 60%? But I actually think, well, what if it doubled? Which is obviously a great result for our members. They've would have made really good returns. But the question is, would you still want to have so much invested in it if that happened over such a short space of time? Now, the answer might be yes, but I think you at least want to be able to own the right to say, well, actually, that has gone up an awful lot. Maybe it's got a bit ahead of itself. Let's reduce it slightly. So those are the sort of things I'm thinking about. If a market just shot up enormously over a short period of time.
Or, for example, you might think that emerging market risk was overdone or underdone as well, and you might want to expand your exposure to those regions too.
Exactly. Yeah, something like that. Exactly.
Okay, and can you talk to us about how you're thinking about evolving the asset allocation? What new developments you're exploring? Anything that you feel you can share publicly with us?
Yeah, we've done a few things over the last kind of year or so. We've got a few things sort of coming down the track as well. I mean, one thing we've looked at a little bit is on the fixed income side, just kind of broadening out what we're doing in the bond portfolio, having dedicated bond allocations, sort of UK corporate bonds, European, US corporate bonds, looking at shorter versus longer term bonds there. So kind of we're trying to really look at the role of fixed income for DC master trusts and come up with what we think are the best portfolios there for our members at different stages of their journey. We're obviously looking at this kind of what's called decumulation or drawdown products. Like a lot of providers will be looking at that and trying to say, well, what are the right allocations to provide for those sort of folks as well. And then, yes, we in terms of allocations, we're looking at and asking ourselves a question, exactly the one you just sort of posed on emerging markets. What are we thinking about emerging markets? Is that something we kind of want, you want to have more or less kind of allocation to? So that's the sort of dynamic kind of decision we have, and then over time as we evolve, we might look to include other strategies in the allocations as well. So private markets, something we talk about, how to approach that kind of space, and that's something we expect to address through time as we kind of grow a little bit and expand the team.
And so, I mean, on fixed income, I think that's really interesting. I mean, that's obviously been the huge story of the past few years as fixed income has come back to life and risen phoenix-like from the ashes in a very rapid way, like U-shaped recovery way. So it sounds to me like you're trying to take an approach to fixed income you've taken to equities and sort of breaking it down, like regionally, within obviously sovereign and corporate, and then maybe by duration as well, long and medium and short. Can you talk to me about what your thinking is about there and where you think what bits would be useful at which stage of a person's wealth accumulation journey as they get to retirement?
Yeah. I mean, that is exactly what we have done as you described it. We're sort of breaking it down a little bit, trying to be a bit more regionally focused around it and a bit more just a bit more focused in our allocations in terms of what we're gaining exposure to. There's a really interesting sort of philosophical questions around for DC investors, the role of sovereign bonds. Do you need gilts? Do you want gilts in your DC allocation? What is fixed income actually doing for you? But yes, as you say, for the first time in ages, these are quite high quality questions because fixed income is sort of back. It offers really pretty good returns. You're looking at some of our high quality corporate bond portfolios, yielding 5 or 6% every year for lending to really pretty safe companies, and those are pretty good returns. So as long as you believe that inflation is going to be going back down around that target, really. So it's a much richer opportunity set than it has been for a long time. There's lots to do there. Interestingly, it's a bit harder to actually know where to almost start from than in equities, because in equities you've got your global kind of market capitalization weightings, which I, as a sort of relative market efficiency believer, I think those are a pretty good starting point. In fixed income, you don't have that actually, so it's kind of green fields in terms of what you want your split to be. We debate questions such as how much should we have in UK fixed income versus overseas. We end up about 50-50 on that question. How much we want in sovereigns versus sort of investment grade corporate bonds, and how much we want in the kind of sub-investment grade corporate bonds. So those are those decisions give us quite a range of different things we can do. Where we're sort of settling is that in that kind of growth phase of the allocations, where we have an 80-20 strategy there, basically 80% in growth assets, 20 in fixed income. For that piece of fixed income, we were looking at a little more duration in there. That's a good kind of return stream to have. Whereas in the more closer to retirement piece, perhaps focusing more on the shorter duration, where the price is not being moved around so much when interest rate expectations kind of rise and fall. The sort of thing you've seen happen this year. Those shorter dated bonds have obviously worked really well this year because they just sort of churned out the coupon without being moved around by the swings in duration. So I think there is a little bit of a different approach to fixed income depending on which part of the members' journey you're putting that in. But overall, fixed income, has a much, I think, bigger role than it did kind of even a couple of years ago when yields were very low and it was really hard to see what it was offering. But now it's a much richer landscape.
Yeah, I mean, that's been the kind of the big punt for the last 2 years has been you have at a point where you can actually make some capital gains on fixed income, which is not something you can usually do if you get the timing right in terms of when interest rates fall and obviously prices rise. And I think we've obviously been and done that in Eurozone because we've already had the first cut, and then everything. This is going to be an interesting month to see if that comes true as well. But once you've got past that sort of inflection point, is it going to be a straightforward outlook in terms of interest rates, i.e. they're just going to be heading down, or do you think there's plenty of stuff to think about whether you will have other opportunities to make money out of bond in terms of prices going back up again?
Yeah, well, I mean, bonds, fixed income sort of yielding, let's say up to 6% per annum, and wouldn't it just be nice if that just arrived every month or every year, sort of in a straight line? I think a lot of investors would absolutely love that. It's a really nice return profile, isn't it? And unfortunately, that's not what happens, because those expectations of interest rates cause the actual prices to move as well. And as you've seen that a lot this year, is the market has really grappled with what the sort of profile of rate cuts is going to look like and how long rates are going to stay high. And I think that's caused a lot of pain for fixed income investors. I'm sure lots of people in DC funds, including ours, who've seen a couple of tough years of performance at the start of the year, they might be thinking, "Great, I've got 6% yield coming," but it's actually been a lot more of a painful ride than that. So yeah, I think where I would come from on that is not so much trying to predict what's going to happen to rates, but just trying to answer the question. Well, we can decide where we want to be on the interest rate curve. If you're really worried about that shifting around a lot and the market constantly reevaluating the pattern for rates, you can place yourself at the shorter end of the curve, and that is a bond that sort of churns out the coupons a little bit more reliably, rather than having the prices that move around a lot as well. Whereas if it's a small part of your holdings held alongside a lot of stocks, then maybe you're not so worried about those sort of fluctuations. So it's just trying to match your strategy up right, I suppose, to your objectives.
Well, I think that's a great place to leave the discussion. It's been really fascinating. It's been lovely talking to you, as it always, Dan. Thanks so much for sharing your news story and all of those insights into how you run the investment strategy at People's Partnership. Listeners, I hope you've enjoyed the first episode of the Professional Investment Podcast. If you don't want to miss any future episodes, then make sure you hit the like and subscribe button below. Thanks again, Dan. And I look forward to many more people listening in. Thanks for listening.
Thanks, Charlotte. Been a great conversation. Thanks. Bye.